Can you make sense of the lack of volatility right now? You can't see this chart, but I'll tell you exactly what it is. It's the market risk index, the index of volatility for all the four main asset classes. And as we know, volatility is at monthly lows. And the gauge I've put on top of it is the global economic policy uncertainty index, which is at a record level. Why are we seeing volatility so low across asset classes when clearly economic policy uncertainty is at heightened levels because of these geopolitical uncertainties?
Well, one thing you have to understand is that the VIX really moves opposite the level of the market. When the stock market is at or near its all-time high, volatility is low. When stock market takes a big fall, people get nervous, they buy puts, they send the premiums up, and it goes high. So one reason the VIX is low is just a reflection of the fact that there's more confidence now. The bulls are coming out. There's less fear of a big market drop. Now, as I mentioned right at the beginning of my interview, if he veers into a protectionist mode, I can see a 10% drop. So I think there is political risk, but the players in these markets look at where the market is, and they also look, as you mentioned, I think just before we came on, that it's been how many days? Over 60 days where we haven't seen a 1% move. These data feed into the computers that tell the players how to play the VIX. No past volatility. They say no future volatility. So a lot of that is just technical there. But I agree with you. If Trump moves in an adverse direction, boy, you'll see the VIX jump up 14, 15, 16. I might be a short-term buyer at these very low numbers.
Well, what measures do you look at? Another chart, Professor, you can't see is, gold versus U.S. bond yields. And Bank of America has said, watch out for the combination of rising yields and rising gold prices, because if we see that happen in combination for an extensive period, a few quarters, that could herald a lot of volatility, as it did in the early 70s and the bond market crash and in Black Monday in 1987. Do you have your preferred indicators which might tell us that we're storing up possible volatility going forward?
Well, one thing we've definitely, since Trump has been elected, we have seen inflationary expectations as marked by the difference between the standard Treasury bonds and those inflation-protected TIPS bonds definitely rise. So we have seen a rise in inflationary expectations. But we also have not seen the long-term bond market fall apart in any measure. And I don't believe we're really going to get much above 3% this year, and maybe even 3.5% in the whole cycle. People still like these bonds. They're diversifiers, they're safety. If there's financial risk, it's what people cling to. There's a huge demand for those treasuries. So I don't know whether we're going to get a lot of challenge from that interest rate figures. And don't forget, inflation data, although it did move up, it's very modest. The dollar is strong. We've seen wages far more moderate than we've expected. Very little pressure from the labor front. So really, there's not a lot of inflation out there, and I think that there's not a lot of reason to all crowd into gold, I think, at this time.